how implied volatility and days to expiration impact the credit we receive. We get this question. We did something along these lines a while back, and then we get the question all the time, like kind of like, what's the formula? What's the model? And what the team did is they went back and they basically figured out how to compute when you have a certain implied volatility and you have a certain number of days to expiration, exactly how that impacts the price. We basically dissected Black-Scholes and came up with some back of the envelope like formulas so you can tell exactly how when something moves. And let's just say right now you thought, okay, well, skews, what's skew today? 160 still, Tony?
160 exactly, yes.
Okay, 160, super high. That means there's a lot of risk of an outlier move. And let's just say that outlier move, just for argument's sake, let's say our outlier moves to the downside and implied volatility. Implied volatility popped.
Volatility, by the way, is unchanged right now.
Yeah. Let's just say implied volatility popped. There's some weird stuff going on today. Bonds down 122. This is on the heels of being down 2 points on Friday.
That's correct.
So everybody that thought, oh my God, all of a sudden they're gonna lower interest rates in March, they're not lowering anything. Not here. Not at 120.06. They're not lowering anything. And yet, if you remember, everybody's talking about, oh, the stock market's rallying because they're going to lower interest rates. Well, now what do? Stock market's still rallying, but they're not lowering interest rates. So who knows what this means?
You punt.
My point is, yeah, maybe you punt. Who knows? But if you punt and implied volatility goes higher, how much is that going to impact the positions you have on? Right?
Yep.
Okay, let's take a look. The team did an amazing job on this piece. It's just heavy. So you can go back to it later. Recently, we did studies that showed how implied volatility responds to large daily moves in price change. After then, we received follow-up questions from viewers asking how implied volatility in different days to expiration can impact the collection of credits. To do so, we expanded on this concept and derived the values that will allow us to estimate credit values and changes in credit for a variety of strangles. We basically went the full distance on this thing. Let's go to the next slide. 18 years worth of research, 16, 30, and 50 delta strangles. 50 delta strangles is just a straddle, just so you know. And then 30, 45, and 60-day timeframes. We measured implied volatility as given by VIX closing prices. We measured the credit received as a percent of the underlying price. That's the key here. Credit received as a percent of underlying price. Let's go to the next slide. So in statistics, a regression is used to explain the relationship between two variables. We put that there. I don't understand it, but you guys might. And so we outlined it all for you. Very Jacob and Gad-like. Let's go to the next slide. You can check it out later. On average, when the VIX increases by 1 point, so right now the VIX is, what is VIX, Tony? I don't have it. Oh, VIX 1447.
That's correct. Up about 62 cents.
Which is a big move in the VIX today. If the VIX increases by 1 point, we can expect our credit for a 16 delta strangle, 45 days to expiration, to increase in cents by 0.6 of a penny of the underlying price. I'm sorry, 6/100ths times the underlying price. Okay, it's 0.059.
Okay.
All right. I know that seems like it's a little bit of, but we've back tested this for 18 years. It's pretty damn good. So we're going to go, and we have a chance of getting to that VIX increasing by a point today. We have a chance.
Yeah.
So let's see what it means. Let's go next slide. So now we'll give you the values, all right, for the other time frames and strangles. Let's go to the next slide. Okay. So this is interesting. So the following are the values that you multiply by the average price, given the average VIX, and to get an estimated credit. So let's say right now, what is there to March expiration, Tony? How many days to March expiration?
March has 39 days to expiration.
Okay, so we're right between the 30 and 45 days. And if you look at the, we did a bunch of different things here. We looked at the 16 delta strangle, the 30 delta strangle, and then the at the money straddle. And we found from looking at this whole thing was that there was an interesting model in that in that we could actually compute how much you could multiply the underlying the average price by to get the difference in your credits. And so it was from 0.056 or 0.059, whatever you want to use, to 0.13, basically kind of like almost like a double, and then almost like a double again, depending on whatever delta we used. And so, we went from hundredths into tenths. Go to the next slide for a sec. So these are the estimated changes in credit when the VIX moves up 1 point. It's like today, if we moved up 1 point, assuming the SPY price of right where it is, if you were selling the let's say the 30 Delta Strangle, and let's say it was, I don't know, let's just say it was $5 this morning, it'd be $5.62 by the end of the day. Let's say you were selling the 16 Delta, and it was like $5, it'd be $5.28 by the end of the day. So you can see the amount that these move, given the amount of time to go to expiration. I guess the objective here for the team was just to show you that that the model is very symmetrical, and that it's also, you can model it. Like that was the whole point. So based on the number of days to expiration and based on how much the VIX increases, we can actually give you a formula which will show you how much the strangles go up. And that's it. They're essentially saying if you sell the 16 Delta Strangle, it's 0.06. And if you do the 30 Delta Strangle, it's 0.12. And if you do the 50 Delta Straddle, it's 0.28. It's just interesting, that'll give you an idea of how much the things will move against you on just, and it also shows you how much, if volatility contracts, how much they'll come in.
Sure.
Without even time going by.
Right. And obviously, right. Without time going by, it's expected risk, right? And reward.
Yeah. Yeah.
I like it.
Yeah. Let's go.
And if SPY was lower, these numbers obviously going to be a lot less. That's why they put in 475 there.
Yeah. Let's go to the next slide. So all the following models represented high correlations, meaning that the model is accurate. Because because like I mentioned before, if you can get like some kind of consistency, something that looks very symmetrical, that the model actually works. And so what we did is we looked at the correlation between implied volatility and days to expiration and found that 95% of the time, or 0.95, that's how tight this correlation was, between rises in the VIX and the amount that the credits went up. So it's very accurate numbers. That was the interesting part, that there wasn't a lot of variation. If you get a higher VIX, you are going to get, higher prices. That's all there is to it. Yeah. So the credit and implied volatility are very highly correlated. Like we said, 0.95 or better. We can expect on average for our 16 Delta Strangle credit to increase by 0.06 times the underlying price in cents when the VIX goes up by 1 point. So now you have a new thing that So if the VIX goes up by 1 point and you have a $100 stock, it's going to go up by 6 cents. If you have a $500 stock, it's going to go up by 30 cents, right? That's what that means.
Yes. Yes.
So using a regression to estimate the changes in credit for strangles allows us to better understand how a certain Delta Strangle, or what it'll be worth given a VIX value and the underlying price. This is how the counterparties, the market making firms, are able to make markets, because basically they have this whole model embedded into their pricing scheme. And the more you understand, the more we understand, we're right there with you, the easier the whole thing is to make sense.
Very good. Nice little segment on expected price movement, P&L price movement on positions that you may have on, which is pretty cool. Very actionable. Let's take a quick 90-second break and come back. We got more Tasty Live coming up next with, oh joy, your friend and mine, Mr. Scott Sheridan, going to explain all of this to us. We'll be back in 90 seconds. This is Tasty Live.